Hello traders, you're welcome to this video and I especially welcome you back to the Forex Geek channel. In this channel, we'll dive deep into everything Forex trading. So if you are new here, don't forget to hit that subscribe button and turn on notifications so you don't miss any future content. And if you find this video helpful, be sure to give it a like. It really helps the channel to grow. So in this particular video, we are going to be tackling an important topic that many traders overlook, and that is high touch versus low touch trading. All right. If you were not conversant with the concept, then you might want to stick around even as we address this topic in this video. All right. So we're talking about high touch versus low touch trading. Okay. Now, what do these terms mean, right? And how do they affect your trading strategy? And most importantly, which one is right for you? So these are some questions that you might be needing answers to, and that is what we intend to address in this video. Let us start by breaking down what high touch and low touch trading are. All right. So high touch trading basically is all about a personalized hands-on approach. Now think of it as the classic trading style where every decision is meticulously analyzed and executed manually. All right. Now, many traders use the high touch trading approach. All right. Because as a high touch trader, you are in control of every step, whether it's analyzing the market, setting up your entry and exit points, or executing trades yourself. Now, talking about high touch trading, if I'm going to give an example, basically, because it's a concept that involves you doing the manual work yourself. All right. So if I want to make use of the high touch trading approach, of course, when I come to my chart, I have to select the trading, the currency pair that I want to trade, right? And in this example, this is the XAU USD pair. So I have to make the analysis myself, right? I have to look at the chart. If I'm going to be using indicators, I can use. If I'm not going to be using indicators, I can work with pure price action. Okay, basically, it boils down to doing the work yourself. Okay, analyzing the chart, perhaps looking for, higher highs and higher lows, identifying the current structure in the market. This is just an example, right? This is just an example that I'm giving. So in this particular example, you can see we actually had a bullish trend here. So having done the manual analysis, then I have to look for entry points myself. I have to look for exit points myself. All right. So having done that, having identified that this is a bullish trend, of course, if you are trading in the direction of the trend, you will want to look for pullbacks, right? You want to watch out for pullbacks. In this particular scenario, we can see that we had a pullback and the price came around here. This would have been a good place to enter a buy. Here again, another good place to enter a buy. Here again, another good place to enter a buy. And here again we go, and here again. Okay, so this is just an example. And then in terms of exiting, yeah, if you are a swing trader or perhaps a day trader and just like to hold your trade for a couple of hours, a couple of days, from the start of the trading day till the end as a day trader, then you might just want to look at entering a single trade and then exiting by the end of the trend, depending on the time frame that you're working on, right? So if we had entered a buy trade, say around here, and let's say we are day trader, right? This is 9th December and this is 12th December. So if you were going to hold this trade till the end of the trade, it means you're going to be holding it for a few days, right? It means you're going to be holding it for a few days. But if you're a day trader that likes to close your trade at the end of the day, it means that once you have identified, a good exit point towards the end of the trading day, you can go ahead and exit your trade. And when the next trading day commences, you can look for another opportunity. Okay. So basically, that is it, right? Now, On the flip side, we have low touch trading. Okay, now this method leans heavily on automation and technology. All right, what we just talked about right here, doing the analysis yourself, identifying your entry and exit points yourself, was high touch trading. Now, talking about low touch trading, low touch traders rely on algorithms, bots, and advanced software to execute trades. All right, so now you can see the difference, right? While you are still responsible for setting up the parameters, like risk limits and trading strategies, the execution itself is often hands free. So that is the case for low touch trading. All right. So high touch involves human expertise and judgment, while low touch is more about leveraging technology for speed and efficiency. Now, let's talk about the benefits of high touch trading. So the first benefit, sorry, the first benefit the first benefit of high touch trading is control. All right. So if you are a kind of trader that fancies control, calling the shots and all of that, then high touch trading is for you. Okay, because with high touch trading, you are calling the shots. Every decision, every analysis, it's all done by you, right? Now, this approach can be great for traders who like being deeply involved in their trades. Okay, now, secondly, an advantage of high touch trading, another advantage rather, is customization. All right, now, high touch trading lets you adapt quickly to market changes. Okay, for example, when you are doing your analysis yourself, let's say you're analyzing gold, XAUUSD, and let's say there was a pattern, a regular pattern in the market, and based on historical patterns or based on historical performances, yeah, there is a way that you have been expecting the price to react. Okay, but suddenly, let's say there happened to be an economic event or one thing or another that resulted in a change in market situation. Now, high touch trading is going to give you that leverage of making necessary adjustments in real time, right? Because you are in total control of the trades. Okay, so let's say the market was initially expected to go in a specific direction, and you know, at a point, there was no respect for market structure as a result of fundamentals, right? There was no respect at that particular point in time. There was no respect for market structure because of fundamentals. There was an economic news or something. So being in charge of your trades is going to give you that upper hand, and you'll be able to adjust your positions accordingly. You're able to adjust your trades accordingly. If there was a need, perhaps you had an irregular breakout, an unexpected breakout and all of that. Let's say, okay, this is just a normal market structure though, but I'm just going to use this as an example. Let's just assume that we had an unexpected breakout around here, and it did not follow the regular price action pattern. And being in charge of your trade, of course, you'll be able to make necessary adjustments in real time. Okay, in real time, unlike the low touch trading that is mostly automated. All right. So now another advantage of high touch trading is that manual trading rather. Many traders feel that manual trading allows for a deeper understanding of the market. Okay, you are engaging with the data directly, which can help improve your skills over time, right? However, this method can be time intensive, right? That's one of the disadvantages of high touch trading, in as much as it has its advantages, which I have already mentioned. The high touch trading method can be time intensive. Okay, so you need to be consistently monitoring the markets, which isn't ideal for everyone. Okay, now let's talk about the low touch trading. Okay, let's just consider the advantages of low touch trading. Right now, one of the advantages of low touch trading is speed and efficiency. Right, low touch trading is built for fast execution. It works with algorithms, right? And algorithms and bots can execute trades in milliseconds. Okay, in milliseconds, which is a huge advantage in volatile markets. Now, secondly, scalability is another advantage of low touch trading, right? If you're managing multiple trades or accounts, low touch trading can work, can help to handle the workload efficiently, right? It's a great option for traders looking to scale their operations. And finally, unlike high touch trading, you are not glued to your screen, right? In the case of high touch trading, of course, you're gonna be glued to your screen because you're making the analysis yourself, checking for market changes yourself and all of that, right? But in the case of low touch trading, you don't necessarily need to be glued to your screen, right? When the system is set up, it can run independently, allowing you to focus on other things. But of course, low touch trading isn't without its challenges. Okay? Automated systems rely on accurate data and preset parameters. If those are off, we could face significant losses. So how do you decide which approach is best for you? Now, if you're someone who values control, you want to do all this yourself. You can see all these lines they plot on the chart, but the trend lines, the support and resistance zones and all of that. You want to make your manual analysis. You want to be in control. Then high touch trading might be your style. All right, if you want a hands-on experience. Now, it's especially beneficial if you're trading on a smaller scale or focusing on specific markets. On the other hand, if you prefer a more passive approach, or if you are trading on a larger scale, low touch trading could be a better fit. Automation can help you stay efficient, especially in fast-paced markets like Forex. The key is to align your trading style with your goals, resources, and risk tolerance. Remember, there is no one size fits all answer. Okay, so here's something to consider. You don't have to choose one or the other. Many successful traders use a hybrid approach, actually, combining high touch and low touch methods. For example, you might use low touch trading for day-to-day operations, right? You can use your automations, your automated strategies and all of that for your day-to-day operations, while reserving high touch trading for more complex, high stakes decisions. All right, this way you get the best of both worlds, right? So that is it for this video on high touch versus low touch trading. I hope this breakdown helps you understand these two trading styles and how they can impact your strategy. Which approach do you prefer? Let me know in the comments below. And if you enjoyed this video, please hit that like button and subscribe for more content like this. Don't forget to share this video with your trading friends. It could spark a great discussion. Trust me. Thank you for watching, and I'll see you in the next video. Until then, happy trading.